At 2:08 p.m. Eastern Time on April 20th, 2020, something happened that the entire architecture of global finance had mathematically declared to be impossible.
The price of West Texas Intermediate crude oil crossed zero. It did not stop there. It kept falling. In the span of a few hours, the most liquid physical commodity market on Earth settled at negative $37.63.
Traders stared at their screens in absolute paralysis. Electronic brokerages saw their software freeze, their databases literally unable to render a minus sign. Automated margin engines stopped functioning. And on the other side of the world, tens of thousands of ordinary people were about to wake up owing billions for an asset they believed carried zero downside risk. The mainstream media blamed a global virus and a sudden halt in aviation. But the virus was just the accelerant. The true cause was much darker and entirely structural. This is the autopsy of the day oil broke mathematics. It is the story of how millions of retail investors in the West and the East were lured into a synthetic trap, how the trading software of Wall Street and Beijing fundamentally failed, and how the true apex predators walked away with billions of dollars simply because they possessed the one asset that no algorithm could manufacture: empty steel tanks. To understand the mechanics of the crash, you have to understand the fundamental difference between a stock and a physical commodity. When you buy a share of a technology company, you own a digital entry in a database. It takes up no physical space. You can hold it forever. But when you buy one standard NYMEX WTI crude oil contract, you are signing a legally binding physical agreement. If you hold that contract until the moment it expires, you are legally obligated to take physical delivery of exactly 1,000 barrels of highly flammable crude oil. And not just anywhere. The contract stipulates a specific geographical choke point, a vast, landlocked complex of pipelines and steel storage tanks in the small town of Cushing, Oklahoma. Cushing is the physical heart of the American energy market. It has a maximum operational capacity of roughly 76 million barrels. Normally, this delivery mechanism works perfectly. Financial traders buy millions of paper contracts and they sell them to actual refineries a few days before expiration. It is a choreographed game of musical chairs. As long as the music plays, the paper keeps moving. But in the spring of 2020, the refineries stopped buying. The problem is that oil wells cannot simply be switched off. Shutting down a massive shale well permanently damages the underground geological pressure, potentially ruining the well forever. So the producers kept pumping at a massive loss. And all of that crude had only one place to go. It all flowed toward Cushing. By mid-April, the storage facilities were approaching 100% capacity. Every cubic inch of available steel had already been pre-leased by massive physical trading houses. The physical musical chairs had stopped. Here is the ultimate asymmetry of the commodity market. Wall Street can print infinite amounts of paper, but physical storage is finite. You cannot download crude oil to a hard drive. If you own physical oil and have absolutely nowhere to store it, the commodity is no longer an asset. It transforms instantly into a toxic liability. You are in breach of federal environmental regulations. You have a disaster on your hands. While Cushing was slowly suffocating, a secondary crisis was brewing in the global retail markets. As crude oil dropped from $60 down to $20 in March and early April, millions of retail traders saw what they thought was a generational buying opportunity. They believed $20 was a mathematical flaw. But retail traders cannot access the physical futures market. Instead, they poured billions of dollars into synthetic financial products. In the United States, they flooded into the United States Oil Fund, ticker USO. In a matter of weeks, USO swelled into a $3 billion behemoth, holding roughly 25% of all outstanding front-month contracts. But the retail tourists fundamentally misunderstood the instrument they were buying. USO does not own physical oil. It is a synthetic algorithm that mechanically buys the front-month futures contract. Because the ETF is legally barred from taking physical delivery in Cushing, it is forced to constantly sell the expiring contract and buy the next month's contract on a pre-announced public schedule, a process known as rolling. This created a catastrophic structural vulnerability known as super-contango. Contango is a market condition where the future price is higher than the current price. Because everyone knew storage was full today but hoped the world would reopen tomorrow, the expiring May contract was crashing to $15, while the June contract was still trading at $25. Every single time USO rolled its position, it was forced to sell oil for $15 and buy the exact same theoretical oil for $25. It was a mechanical, wealth destruction machine. Worse yet, USO's rolling schedule was entirely public. Every proprietary trading desk on Wall Street knew exactly when the ETF had to sell and exactly how many contracts it had to dump. The institutional traders simply front-ran the dumb whale, relentlessly shorting the front-month contract, knowing USO was legally forced to sell into a market with zero liquidity at any price to avoid physical delivery. Retail traders in America thought they were buying cheap oil. In reality, their capital was being surgically extracted by the institutional market structure. USO actually survived. Their portfolio managers recognized the storage crisis just in time and rolled their contracts days before expiration. They bled massive capital, but they escaped the physical delivery trap. On the other side of the world, a completely different class of retail investors would not be so lucky. While Wall Street was quietly exiting the May contract, the Bank of China, one of the largest state-owned commercial banks on Earth, was aggressively marketing a structured financial product to its domestic retail clients. It was called Yuan, Crude Oil Treasure. The bank pitched it to ordinary investors as a safe, accessible way to bet on the global recovery of oil prices. It was marketed to people who had absolutely no understanding of futures markets, margin requirements, or physical delivery logistics. It was sold as a product without leverage. The worst-case scenario, as far as retail investors understood, was that oil went to zero and they lost their initial principal. Over 60,000 Chinese retail investors poured their savings into Crude Oil Treasure, buying the dip just like their American counterparts. But the risk management department at the Bank of China made a fatal institutional-grade error. Unlike the American USO fund, which rolled its contracts well ahead of the deadline, the Bank of China designed Yuan to hold WTI futures contracts right up until the final hours of trading on April 20th. They wanted to track the absolute final settlement price to avoid rolling costs. They fundamentally believed that liquidity would always be there, that they could dump tens of thousands of contracts into the open market at the last possible second. They were completely blind to the reality of the Cushing steel tanks. Monday, April 20th, 2020. Expiration Eve. At 10 a.m. New York time, the Bank of China's trading system for Yuan automatically locked. The platform closed for the Chinese business day. 60,000 retail investors were now mured inside their positions with no way out. They could not sell, they could not close, they could not even call their bank. At this exact moment, the May WTI contract was trading at roughly $15. The price was falling, but still positive. still rational. The investors who were now sealed inside their positions had no idea what the next 4 hours would bring. On the trading floors of New York, the institutional predators did. The Cushing storage data had confirmed what the smart money already knew. The tanks were at 100% capacity. Anyone still holding a long position in the May contract was no longer playing a game. The physical exits had been welded shut. If they did not sell by the end of the next day, they would be legally forced to accept delivery of crude oil in a landlocked Oklahoma town where there was not a single empty tank left. The squeeze began. The institutional desks aggressively sold the market short, refusing to buy the contracts from the trapped funds. The price collapsed. $18, $10, $5, $1. And then, at exactly 2:08 p.m. Eastern Time, the price crossed zero. At this exact millisecond, the digital infrastructure of global finance began to break down. The risk engines powering most major brokerages had been built on a single architectural assumption. Asset prices cannot go negative. Their margin algorithms were hard-coded with a price floor of zero. When the price inverted, the code hit a mathematical impossibility and stalled. The systems that should have issued margin calls and liquidated accounts went blind. By the time Interactive Brokers engineers manually overrode the system, the firm had suffered an $88 million loss straight to their corporate balance sheet, simply absorbing losses their own risk code had failed to catch. And through all of it, the 60,000 Chinese retail investors locked inside Yuan Bao could only watch. It was the middle of the night in China. Their screens showed frozen numbers. Their phones rang unanswered. They had no mechanism to act and no information about the scale of what was happening. They were sealed inside a burning building, unable to find the exit, while the fire consumed everything. By 2:30 p.m., the market had completely unraveled. The price bottomed at negative $37.63. It wasn't a price anymore. It was a waste disposal fee. Desperate paper traders, funds and banks were literally paying physical buyers $37,000 per contract just to take the legal liability of the oil off their hands. When the Chinese retail investors woke up the next morning, they realized they hadn't just lost their entire investment. Because the price settled deeply negative, they now owed the bank billions of yuan. A mom-and-pop investor who put $10,000 into Crude Oil Treasure to buy the dip suddenly received a notification that their account was empty, and they owed an additional $18,000 in personal debt. It sparked a national outrage, forcing the Chinese government to intervene and forcing the Bank of China to absorb over $1 billion in losses, all stemming from a failure to understand the physical constraints of a market 7,000 miles away. When the dust settled, the financial media framed it as a global tragedy. But the commodity market is a zero-sum game. The money did not evaporate, it was simply transferred. The true winners of April 20th were not algorithmic quants. They were the physical commodity trading houses, firms like Vitol, Trafigura and Gunvor, companies that actually owned and operated the steel tanks in Cushing, Oklahoma. They had been quietly pre-leasing storage capacity for months, watching the Cushing data with precision. When the price hit negative $37, they stepped in. Think about the math of the perfect trade. They were paid nearly $40,000 per contract simply to open their valves and let the crude oil flow into their tanks. A few weeks later, when the June contract normalized, they sold that exact same oil back to the market for $30 a barrel. A risk-free physical arbitrage. $70 per barrel in pure profit, harvested from the algorithmic panic of Wall Street and the structural incompetence of retail banking. Over the following weekend, the CME Clearinghouse quietly deployed a fundamental rewrite of their core settlement model. Because the standard options pricing model uses a natural logarithm, which is mathematically undefined for negative numbers, the clearinghouse shifted to the Bachelier model, an older mathematical framework that actually allows for negative asset values. They had to rewire the global financial system to accept a new and terrifying reality. If you want to survive in the institutional commodity markets, you cannot just stare at the flashing numbers on a terminal. Wall Street relies on the mathematical certainty of its algorithms and the illusion of infinite liquidity. But on April 20th, 2020, the smart money learned a brutal lesson. When the music stops and all the steel tanks are full, physics will always override mathematics. This is the anatomy of a systemic market failure. I'll see you in the next one.